Hi everyone, this is Craig, the options linebacker, and this is the weekend report for Sunday, January 24th. Well, if you were watching the markets last week, you'll know that last week didn't end too well. So what I'm going to do today is look at the S&P 500 and see if there's any clues that'll let us know where things are likely to go from here. We'll start out with the highest time frame, the monthly chart here, and then continually work our way in to look for clues. So what we know so far is that in October 2007 we went from a higher high on the S&P to, through this bear market, a lower low that ended in March of 2009, and since then it's been 10 straight months the upside. Now we know that since the market went from a higher high to a lower low, what's most likely to happen is for it to roll over in a lower high and keep working its way downward. At some point it'll bounce, but we don't care about that right now. All we're looking for is that lower high, as we know it's very unlikely for it to go straight back up here and go from a lower low to a higher high. So is this the beginning of our lower high? Well, so far we have a shooting star on the monthly chart. Now there are 5 more days to trade in January, so this one's not baked yet, but it's a good start for perhaps the start of a rollover. Now just thinking forward, if we draw the fibs starting from here up to here, these are Fibonacci retracements, we'll find the 38.2, 50%, and 61.8% fibs at these levels, with the 38.2 being at 966. So that would trim 200 points off of the S&Ps before this would bounce, but this wouldn't be actually a bad pattern if we step back and look at this. It's just that while we're undergoing this 200-point retracement, it would definitely feel like the next leg of the bear market is kicking in. Believe it or not, that bearish sentiment is actually required for this market to go further up. Now, why would that be as we go to the weekly chart? Well, sometimes it's better in markets, as in a lot of ways in life, that it's helpful to take a couple of steps back before you can take a leap forward. And you can see how this has worked out on the weekly chart as we got into the June-July retracement. So we waffled around and retraced for about 6 weeks before all of a sudden we had literally an explosion off of there. And what creates these explosions is the fact that you have a lot of sideline money that missed out on the first part of this rally, patiently waiting for retracement, number one. And number two, you had a lot of people, a lot of new bears that went short here saying, okay, we're rolling over into the next phase of the bear market. And those people were wrong as we started getting very, very good earnings reports, at least at that time in July. If you're a bear and you're wrong, what do you have to do? Well, you have to cover. So that creates double the amount of bullish fuel to the fire, and it creates these huge explosions off of the bottom, in this case, the July bottom. So even though we had a bad week, this is just all normal. And it's just a matter of where this market's going to find support. So number one, the bulls that are on the sidelines that have missed out on this whole huge move here can find an entry point that makes them comfortable. Institutional investors are very, very patient and they will wait for the pullback. And secondly, at what point will the market be convinced, especially the new bears be convinced, okay, now it feels good to enter short? That's usually right around the time that they're going to get bent over backwards. So we're seeing a couple of levels here could potentially be used as support on the weekly chart. One would be around the 1,000 to 1,013 level on the S&P, which is a long way down there actually, as well as that 950 to 966 level that we showed on the monthly chart. So this one looks to be a bit more reasonable for a weekly pivot. Okay, that's the long range view. Let's zoom in on the daily chart and see what's happening today. Now when we go into the daily chart, we can see a little bit more detail here that gives us a little bit more of a signal about what might happen over the next few days. First thing that catches my eye is the prices below the Bollinger Bands. And if you go back on these strong rallies and retracements that we've had over the past few months, the price does not stay outside the Bollinger Bands for very long at all. What it's saying is that the price has come too far, too fast, and needs to catch up with the sentiment of the market. So the signals that we're seeing here on the technicals is that we have the price outside the Bollinger Bands, very likely to kind of snap it back. You can think of the Bollinger Bands as kind of like the ropes in a boxing ring, is that the boxer can get pushed back through the ropes, but he'll eventually get sprung back inside the ring again. And we have some oversold stochastics down here as well too, showing that short term things are a little bit oversold, a little bit too stretched to the downside. Now let's just look at price on the S&P chart. Now I do have a couple of moving averages on here, but that's about it. Price won't lie to you, as we talked about on our top 10 lessons for 2009. So going back, we've had swings like this before, so these shouldn't be surprising to us. We've had similar moves where we lost, in this case, back at the end of October, lost 72 points in just a couple of days. The last corrective swing, and since then we've just been motoring higher. So this one's only 60 points so far. So we might see a little additional downside here if the swing lengths are going to be similar, and a lot of times markets are very, very uniform with this. Secondly, what I'm noticing is that now price is back inside of this whole consolidation box. It may make sense for the price to go all the way back down to around 1085 and explore the bottom of this to see if it can once again pick up some more support down here. Now what we talked about is during bull markets, or bull market moves at the very least, even if this is just a bear market correction, you will typically have 10% corrections along the way. Now we're nowhere close to that. We're about half of that right now, so 10% correction would come into play around S&P 1035. But it's very unlikely to get there just all of a sudden in one impulse move like this. Typically what happens with corrections is that they are fractal in nature, is that they'll come back up and retest a former support line that is now resistance and then start waving their way to the bottom until it does create that correction. And this is where everybody gets all bearish and starts to get the negative sentiment all stoked up, which creates the next move higher. One tool that we can use to kind of help us figure out where we are in this correction is to throw fibs on here. And if we look, we have the 38.2% fib retracement comes into play right around 1113, which is very close to the top of this box, this whole consolidation range. So that once again supports that what we might see is a short-term bounce, come back up here and make everybody go, okay, phew, we're going to do this again. We're going to go straight back up. But then it may find resistance at that level, so we'll watch that one very carefully to see whether or not it's going to punch through there and keep heading higher, or roll over at that point and start moving lower in a fractal fashion. Okay, so let's quickly recap the signals that we're seeing right now. We have a weak bullish cluster in the market timer. We have the price outside the Bollinger Bands. We have oversold stochastics. We are close to another oscillator, which is the RSI2 signal that I watch. So that would be a long signal if it dips below 2.0. And the fact that intermediate market tops are very complex. You usually don't just drop off the top. A lot of times you'll come back up and back test the broken trend lines that we have currently in place. So these are all very short-term bullish signals. Now to balance that out, we also have some short-term bearish signals that it looks like there's a bit more downside on the S&P before it fulfills the typical swing length. And we do have strong resistance levels overhead if it does bounce from this level. And we're only seeing a 5% correction so far. Is this going to be a 10%? 5% is not that much. The last point here I think is very important. We haven't seen what I call true capitulation price action yet. That's where you get signals like this with long lower wicks on the candlesticks. Like here, every time we test support, there's no capitulation yet in a candlestick like this that closed very close to the low of the day. The big question everybody's got on their mind, where the market's going from here? Well, it's important, believe it or not, that you try not to forecast the future. So if you're lucky, you'll get it right, but don't forget that it's the market's job to really mess up the greatest number of traders out there. Instead, develop a plan for what you will do based on what it, being the market, does. That way you won't have that deer in the headlights syndrome. You're just executing your plan. It makes it much simpler that way. Thanks for listening. Have a great weekend, folks.